Crude oil has surged today as investors react to another increase in production quotas at OPEC+. The increase was less than some market participants had thought or even feared. Joining us now to talk about all of this is Rory Johnston. He's founder of Commodity Context. Rory, thanks a lot for joining us. The price of crude oil has really taken off today. Explain the market's thinking here in terms of what we have seen from OPEC+.
Yeah, so thanks for having me, Paul. I think the two main things that are really driving this kind of Monday morning rally we're seeing is, one, as you noted, OPEC announced a 411,000 barrel a day increase for July on its meeting on Saturday. Now, that's strange, right? To think, why is the price jumping when you got actually a fairly large pledged increase from OPEC? And the answer is that in the later kind of days of last week going into this meeting, there began to be a rumor circulating that we could see an even faster increase in production at this meeting for July, potentially upwards of the entirety of the rest of the kind of return of those 2.5 million barrels that they've been promising to return. And just for context here, this all started what was supposed to be a really kind of gradual, almost boring return of 2.5 million barrels a day over 18 months. Now on our current trajectory could actually be returned in 7. That's a lot of oil very, very quickly, and on paper should almost surely tip the market into oversupply. The weird thing we're seeing is that so far we haven't seen that much oil. Already more than 1 million barrels has actually already been pledged to be returned through June. And yes, we are now in June, and the markets are still relatively tight. The other thing that has driven this tightness over the weekend in particular is far closer to home are these awful Alberta wildfires that we're seeing. And one in particular is in the kind of eastern portion of the province, just by a lot of the major oil sands sites on the in situ and thermal side. So this morning we saw confirmation that Cenovus's Christina Lake facility has temporarily pulled back on production. That's almost a 250,000 barrel a day production facility. So that has dramatically increased the tightness in North American markets, which you can see most notably through the kind of surging prompt calendar spread, or the front of the forward curve for WTI. So all that together, we're getting really, really weird mixed signals, and this longer term kind of abstract bearishness and all of our current realized signals right in front of us still scream bullish.
Do really weird signals, to use your phrase, suggest that today's dramatic rally in the price of oil is misplaced, that this could be a blip?
I don't think so. And because I think there's two ways that we can differentiate this. I think that the longer term signals are mostly bearish, and we see the broad kind of structure of the futures curve for crude, both Brent and WTI, in contango, which is kind of associated with bearish market conditions, oversupply, and stock building. Now, at the front of the curve, however, this is the actual portion of the curve that you and I are living in basically today, is extremely bullish. And we've actually seen over the past week the kind of spread between the first contract and the second contract, that is your strongest kind of read on current physical markets and kind of current tightness, has doubled in its spread for WTI over the past week. A lot of that's being driven by these wildfires in Alberta. But I think more broadly, if we were in a market that was kind of on the verge, on the precipice of kind of overwhelming oversupply, it's a really strange signal to see. So again, the market is really debating how much of this OPEC oil is actually coming back to the market. Some of this has already been returned through cheating and other things, so that diminishes some of the expected return of these barrels. But even Saudi Arabia, which has been pretty on the point on its kind of production policy, has already eased back more than 500,000 barrels a day of quota, and we have yet to see a lot of that actually hit the market. So I think the market's still trying to figure out how much of this is just rhetoric and how much of this is actual barrels that are going to be hitting the market.
Okay, we've talked about supply. Let's talk about demand. What does the demand outlook look like for the remainder of the year or beyond?
Yeah, so last year, demand was really, really weak. And that was primarily driven by China actually slipping from its strongest annual growth on record in 2023 to actually its second annual contraction in demand in more than 20 years. So Chinese demand has been all over the place between COVID zero, recovery, and strong penetration of EVs and natural gas fueled kind of transportation trucks and all these other things. So We have seen a little bit of a rebalancing and a kind of a leveling off in that weakness in the first quarter of 2025 so far, according to my numbers. But we still haven't returned to that kind of steady state 500,000 barrel a day plus that Chinese demand typically kind of represented in the market. Funny enough, the area that has overwhelmingly for years now been a bearish outlook for demand, which is North America and Europe, has actually been recently one of the sources of relative strength, recovering from a lot of the storm effects last year. But I think more generally, we just aren't seeing the declines in OECD or advanced economy demand that we would have expected. Couple that with kind of further growth in Indian and Korean demand and all the other major developing economies outside of China. And it's still been a relatively firm demand backdrop, at least for the first couple of months of this year. I think longer term, still a question of policy, still a question of energy transition. But again, similar to this question of OPEC and supply, the outlook is pretty bearish, but what's happening right in front of us continues to be pretty bullish.
How affected is the demand picture by the shifting headlines and news that we get on U.S. tariff policy?
Yeah, I mean, absolutely. I think not just for oil demand, but kind of across the kind of macroeconomic spectrum. I think what we've seen here, I think we're living in the middle of kind of a really, really awful economic experiment in many ways, because while the actual kind of nominal tariff on the books for any given country is some kind of drag, that's obviously drawn tremendously from the levels that we saw in early April with the reciprocal kind of Liberation Day tariff announcement. But I think the bigger drag here on investment intention and general activity and spend is just rampant uncertainty. So I think with no one knowing where the tariffs are going to land, no one can really put their kind of capital in the ground trying to figure out where to put it. And I think that is why we're going to be living in this experiment a little bit for the next couple of months, because as long as the Trump administration keeps back and forthing, no one's going to actually put capital to work. And that can only go on for so long before it has a really strong negative impact, particularly on the United States, but I think more broadly around the world. And if the economy slows, oil demand is going to follow.
Okay, we're out of time, but briefly, Rory, tell us a bit about Commodity Context. That's the product that you offer to people who are interested in the energy market.
Thanks, Paul. Yeah, so Commodity Context is my oil and gas research firm. I used to lead commodity economics at Scotia, and now I'm doing a lot of this on my own. And it's just my attempt at kind of providing a slightly more independent, kind of data-driven and visualization forward view of this market to people like myself and hopefully like yourself are really interested in kind of understanding what really makes the oil market tick.
Rory Johnston, thanks a great deal. He is, in fact, the founder of Commodity Context. Coming up.